A new survey from the Dallas Fed is showing lending conditions didn't change much in mid-June, which our guest says could be a sign of further deterioration to come in the Fed's next senior loan officer opinion survey. Yelena Shulyatyeva, BNP Paribas U.S. Economist, is back with us. So we don't have that senior loan office sleuth. I can't even say the whole name yet, right? But the Fed will have it at its disposal. What does the Dallas Fed survey tell you about what we can expect from the sleuth?
What really concerns me from the Dallas Fed survey is not only tightening in lending conditions, but also weakening demand from the consumer and from the companies as well. So there's commercial and industrial loans, and you see a slowdown in demand on that front. And that is your investment sector of the economy. And you also see a slowdown in demand from the consumer. Of course, we do talk a lot about how consumers would love to buy more cars. There's a lot of demand and still not enough supply. But overall, consumer demand is slowing for borrowing. And that is a big deal for the economy. And I think what was evident in the Texas survey, which is a kind of a microcosm of the United States, if you will. But you can also see that on a nationwide basis. And we could see that lending conditions tightening, slowing demand, will start to slow down what consumers are doing.
I mean, when we think about how this impacts small businesses as well, any tightening of credit conditions and small businesses' representation of, 50% of U.S. GDP, what kind of broader impact could that mean for the economy, considering the blow to small businesses that could create if there was an extreme tightening in lending conditions for them? Well,
small businesses also represent a big share of payrolls, of hiring. So if they slow down the hiring process, that will impact different sectors. For now, what we see is, there's been a lot of structural changes due to COVID, and it's still a lack of workers in leisure and hospitality sector. So that's why we see robust hiring in that sector, which is represented by small businesses to a large extent. So there's demand there, but if we start losing jobs in higher paid sectors such as finance, high tech, we have seen a lot of layoff announcements. So you cannot really replace all these higher paid jobs with lower paid jobs and have the same level, same growth in income, because that's going to be a hit to personal income growth, and that's going to be a hit to personal spending as well.
Then you need two for the price of one.
Which is exactly two, because average hourly earnings in the tech sector and finance are twice as large as those in leisure and hospitality, for example.
And I want to ask you a quick question. You talked about the consumer. The consumer has held up very well in terms of the economic cycle in general. Are you expecting the consumer to continue to hold up, especially with tight lending standards, through the balance of the year?
We already see a slowdown in the goods sector. So we're not buying as many, sofas and backyard equipment, whatever.
Okay.
What we haven't seen so far is a slowdown in services. We're still going on vacations, and I think we will see that in the second half of the year as all those high-paid jobs start to, shrink or at least slow down, and people will get more cautious about spending on services.
All right.